The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. I hope you've all had a wonderful Christmas. Can you hear me all right, folks? How's the volume over there? Yes, Mark says good, and Kevin as well. Good. So we've got volume. Nice to have you here. I hope you've had a wonderful break over the Christmas period. And President Donald Trump, yeah. I hope you're feeling really looking forward to the new year when we can get back to some trading. Let's see, all the usual suspects are with us. Good to have you with us. Let's have a look here. Yes, great. Oh, we've got a big roll up today. This is a bit late. We normally would have done it on the previous Thursday. Ed's with us. Hello, Ed. Good to have you with us, my friend. Hank down in the Hunter. I know you've had a lot of rain down there, haven't you, Hank? Be a bit better. Harold the Gold King from Redding, California. Jeff is a tutorial guy. Joel, good to have you with us. Kevin, of course, from Minnesota. Kevin from Minnesota, good. Mark, a couple of Marks. Mark about to do a tutorial next week, and another Mark who's done a tutorial. Good. Let's see who else we've got here. The usual. Mike the Murphy. Nice to have you with us, Mike. Thank you for your Christmas wishes. Neil, I think you're still on holiday somewhere, Neil, but good to have you with us. Peter, of course, he's the short-term trading guru. Going to do a Danielcode tutorial sometime later this month, perhaps. Philip, yes, good. Lovely. Okay. And Sean, of course, is doing a tutorial. About time we had another talk, Sean. I'll be back in the office again next week. I've had a few days off this week. A bit of a shock to the system, you know. We say that we will try and take off a week. We'll take off a week every quarter. This year, of course, like last year, we haven't managed to stop. The trading's just been so good, I couldn't tear myself away from it. But so we do have a few days off over Christmas. We should have a device. Here it is. So let's move on. As you know, markets are rational. Everything's good. Any problems? I'm getting a few dings on this headset coming back from GoToWebinar. If you have any problems with the sound, do just type in the question box and let me know, folks, won't you? What are we going to talk about? I mean, any review of 2018, there have been some great trades, but none greater than what we've had in the equities, US equities. S&P's been phenomenal. We've had two huge bursts of volatility in February and in September. This latest one's still ongoing, and it's been marvelous. And the point I'm going to try and make to you today is that even especially in times of raised volatility, markets just become more accurate on their Danielcode ratios. You can see this is a pretty simplistic presentation of where the high came in. That it's actually 2.593 times the first big push out from March 2009 into May 2011. So you can see this idea that I'm trying to. None of this is random. All of this works on a given number of ratios, and those ratios are the Danielcode ratios. This is the same chart. We're now looking at the second big swing up, the one that went from March 2009 up to the January 2016 high, and 2015 late. This is a 24-day chart, folks. 24 days to a bar. So that was the very late 2015 high, and then we extend that 0.74, which is one of the Danielcode ratios, and we got the closing high almost exactly. So there are at least two, perhaps more, ratios running inside these setups. But all of this is totally mathematical. It's not so exciting on a forecasting basis. We have other tools to do that. But looking back, just keep referencing the fact that all markets are fractal. That is, they're a function. All highs and lows will be made at functions of previous ranges. And they're the very, very specific ratios that accord all of that. And those are the Danielcode ratios. Let's move on. It's extraordinary, isn't it? If we, whatever happens, whatever we've got in store for us coming forward, is very, very dependent on what's going to happen in the Nasdaq. This is the big booster. You can see there the 2000 highs, the .com highs. And you can see what a weak rally it was into 2007, whereas the broader markets were making new highs at that time. The Nasdaq could barely get out of its way. And now all of a sudden it's absolutely parabolic. And because that has fueled so much of the growth, tech-type stocks, that's going to be what determines what happens going forward. And as you can see, the correction in the Nasdaq is not terribly severe compared to what's happened. So it's the stronger side of these markets. I'm just going to run you through some of the other markets around the world so you can get a view of what's been happening. We need always to be aware of longer term charts, which we don't look at enough. We're all guilty of it, me included, that we tend to focus too much on our daily charts, what we're actually trading. But it's very useful to have your longer term charts. These are all 24-day charts, which is the Danielcode month essentially. Each one of these bars has 24 trading days in it. This is the Australian share price index, which is Australia's equivalent of the S&P, if you like. It's the 200, they call it the SPY 200, share price index 200. It's the 200 biggest companies in Australia. And as you can see, it's struggled and has never regained its 2007 high. Unlike most of the US markets that have, fast past that. So this market hasn't been terribly exciting. It's a market that's heavy on industrials and service companies, doesn't have a lot of tech in it, and that's one of the reasons why it hasn't been as exciting as we've seen with the US. 2, 3, 1, 2, 3. We're getting a breakup of sound, folks, or can you hear me all right? This is the US dollar index. Can you hear me, folks? Just type in the question box, would you please? Right. Just stand by. Yeah, I'm breaking up. Mike, in and out. Okay, thank you. Just stand by, folks. I'm going to put a different headset in here. Just stay with me for a moment, please. Just stand by, folks, please. I'm just going to replace this headset with another headset. It might take a minute or two. Norbert, good to have you with us, my friend. Yeah, it'll come back, John. It'll come back and break and fade up. So it's simpler now to just replace that headset which will just take about 2 minutes if you'd be kind enough to indulge me. Let's see. Well, while we've got something, we might as well keep going while the news headset is on its way over. So this is the US dollar index. You can see it hasn't done terribly well under President Trump, but that's a part of his policy. He's a typical businessman. He wants the weakest dollar he can, because that weaker dollar makes exports more profitable, and imports more expensive. So the consumer's getting killed. Okay, stand by. Just stand by, folks. Okay, I'm just going to put the new headset in and hope that it's going to be effective for you. Just bear with me for a moment while I just get rid of a few of these wires. Thank you. Okay, 1, 2, 3, 1, 2, 3. How's that volume now, folks? All right? Yeah, sounding good, better. Okay, thanks so much for your help, folks, and my apologies. Technology is something that's a bit beyond the control of any of us, but there we are. So, well, that wasn't too bad, actually. That's like a $27 Logitech that I've had for about 12 years. So I can't begrudge the fact that it's died a natural death. Okay, so it's Trump's typical businessman's mercantile policy to be looking for a weaker dollar. You can see over the year the US dollar's done very little, and things I thought last year that it would be good. I thought the US dollar was going to break through its old highs around 103.93, but it certainly didn't. In fact, I didn't even bother showing you my predictions from last year from this Christmas meeting, because they were all so bad. So we should. 1, 2, 3. Can you hear me now? We should be sticking to the mantra of J.P. Morgan, who said, well, markets fluctuate, sometimes violently. That's about the best shot at them. This is what's been happening in China. This is the broad index, the Shanghai Composite, and it's totally different to what you see with the Hong Kong. Kevin, I'm sorry if it's in and out again. Then we've got a issue at Citrix that go to webinar, the people who are hosting this. Because it's got a brand new headset into it, and it looks to be working okay. So if you do get a bit of breakup, just bear with me. I do apologize. Okay, so very different what's happening between Hong Kong and the broad index in China. More and more of China is getting urbanized, and more people are being aware of investments. Of course, the Chinese are dedicated money makers. They're into any opportunity they can to make money. But this their share market dollar. This was one that I thought would be a really good short this year, and it has gone down. But the government's pretty stubbornly supporting just below 70 cents. And we're heading for that again now. I still think this currency is overvalued. There are a heap of problems in the Australian economy, mainly to do with housing. The price of housing in this country, particularly the two capital cities, Sydney and Melbourne, is quite absurd. If I tell you that the average price of a home in Sydney is just a tick under $1 million. And then you start to think about what average means. I can tell you it's not great. You wouldn't be killing yourself to get one of the average homes. And it's $980 odd thousand. It's totally ridiculous. And what's happened there, and it happened all over the world, is really the huge growth of women working. You can't justify the sort of price levels we have around the world on any basis from a single salary. Very, very few examples of that. But since women have entered the workforce so strongly, which is nothing that new, effectively prices have doubled. Average price have doubled because you've now got two lots of income. And the price of property is also a function of what the banks are prepared to lend. And the Australian banks have been going gangbusters on it to get up to those ridiculous sort of prices. And they've been doing all sorts of tricks with, very, very low deposit, fudging the real net available funds for repayment, all that sort of thing. And we've just had a Royal Commission, which is a formal inquiry by a judge, into the banks and the superannuation funds, and all this stuff has come spilling out, and it's been dastardly. They have been very, very, very bad boys, but as usual, none of them seem to have gone to jail. The executives still seem to be getting their $4 or $5 million bonuses, some very much higher than that, and what they've been doing with their running the business has been shortcuts, and almost all public companies, they've been promoting the shorter term view because they're not actually running the company entirely in your interest. They're running it predominantly in their interest, which means short-termism rules because they need to hit those KPI targets to get their bonus, which is the be-all and of everything. Anyway, I think the housing bubble in Australia is gradually start to unwind a little bit. Nothing like what's going to happen. That's only happened for the last 12 months. It's down less than 10% in those two major cities. Not so much of an effect elsewhere where there hasn't been this mad influx of immigration, particularly the Chinese. They love buying property, and we had a couple of years of pretty much open slather, which both China and the Australian government are trying to tone down now. But if we look at the fact that the price of real estate all over the world is very much a function of bank lending policies. In Australia, we're going to have very, very much more constrained policies, but the market's gone down less than 10%. The Reserve Bank's panicked already. They, together with the prudential supervisors of banks, had put limits on the volume of interest-only loans that could be put out. They said we can't do more than 30% of your book in interest-only loans. That's lasted less than a year, and now the market's going down. They panicked and said, "Oh, yeah, you can. Go ahead with your interest-only loans. We don't want to have a real estate crash on our hands." But I think it's there are severe problems. They're going to take 3 to 5 years to roll out because most of the shonky stuff's been done on 5-year interest-only loans. And an awful lot of those, when they come around, are not going to be able to be refinanced. Really, it continues to show levels of weakness, but it's been fairly dormant. British pound continues to get whacked, doesn't it? It's just total disaster over there. I mean, it's a miracle that it's holding on as well as it is, considering that Theresa May, the British Prime Minister, has had 2 years to negotiate the Brexit exit from the European Common Market, the EU, and in that 2 years, all she's managed to come up with is an agreement for another consultation period of another 2 years. I mean, it is so cloud cuckoo, it's hard to understand, and I try to keep up with sort of politics and economic drivers around the world. And I've always had a pretty good feel of what's happening in the UK, but boy, it's beyond me now. I just she withstood a no confidence vote by only 2 votes in the House of Commons last month. It's beyond me. The level of incompetence is just scary stuff. One of the problems is Theresa May herself, who was a minister in the previous government, the Cameron government. She's a Remainer. The people on Brexit, the big issue in Britain, do we stay in the European Union or do we leave the European Union? They're referred to as leavers and remainers. And she's a Remainer. She wants to stay in it before we had the referendum on Brexit. And the government, such as it was, installed her as the new leader after Cameron resigned. So, they put in a person with no commitment to leaving the EU, which is what the country voted for in a huge referendum. And they were too frightened to go for the obvious player, who's Boris Johnson. He was the leader of the Leave campaigns. He's a flamboyant character. I'm not going to tar him with the brush of saying he's got a bit of the Donald about him, but he's certainly a very flamboyant character. He's been mayor of London. He's shown a fair bit of confidence in his parliamentary career, but they wouldn't have him, so they've chose a Remainer and said, well, see if the leopard can change its spots. Well, the answer is not usually. This is the US T-bonds chart, folks, on the 24-day chart. I've shown you this periodically over the years, and it's covered with time cycles and everything else. The important thing to observe here is that we had the high sometime in May 16. And remember, this is the price of US T-bonds, which means it's the inverse of rate. So as this market goes up, it means US interest rates on the 30-year T-bond are going down. And vice versa, when prices are going down, it means interest rates are going up. And you can see here that the effective interest rate on the US 30-year T-bonds has gone from the top of the Danielcode trading channel, 2 standard deviations. They're not normal mathematical standard deviations. They're Danielcode standard deviations. 2 Danielcode standard deviations from the mean. It's now gone all the way down and is sitting not far above 2 standard deviations below the mean. Well, that's interesting for a couple of reasons. First of all, it's proof of Sir Isaac Newton's law that we see in markets all the time. That is second or third law, I forget which one. Every action has an equal and opposite reaction. We get this market belting against the 2 standard deviation line. We expect it to at some time correct to the -2 standard deviation line, which is exactly what it's done. And that's actually put these effective long-term interest rates back to about 2012 levels. And we're not seeing that really in the flow through to shorter-term interest rates. It should be much more dramatic than it is. I'm not talking about the sort of stuff that the Fed aficionados go on with. A quarter point here, there, or everywhere is actually immaterial. Bond vigilantes like to get themselves in a rage about it. But this market's pulled back the whole width of 2 standard deviations from the mean. Well, +2, it's now -2. This should have had a much stronger effect on short-term interest rates, and it hasn't. We should so there's still a huge amount of stimulus being applied by the Fed, even though they don't want to acknowledge that. This is COMEX Gold. I know a lot of you are gold buffs, and we've got our champion from Reading with us today, Harold. And a couple of weeks ago, when I was doing a tutorial or a webinar, I should say, with you, I said that gold has decoupled from its inverse relationship with the US dollar index. I actually wrote an article about that some years ago, And that inverse relationship between gold and the US dollar index happens often, not forever, but for long, long periods of time. And when it decouples, so far on the last 7 examples, it's always been positive for gold. And in that webinar, which might be either 2 or 4 weeks ago, or maybe even a little bit longer, Harold will remember, I said that gold looked very promising now because it's decoupled from the US dollar index. And as a result of that, I think gold is going to be one of our stars of 2019. And that would mean also that would apply to silver. So I think the big trade opportunities are going to be in precious metals for the coming year. Palladium, those of you who follow it, is through the roof anyway. And gold, you can see how low it got in August 2018. This is a 6-day chart. It's got a whole lot of upside ahead of it. So I expect gold and silver to be two of the trading stars to the upside in 2019. This is crude oil. This has been one of our great trades the last couple of months since the high came in September. Boy, it's been something, hasn't it? This red line on there is really interesting. That's the fourth seal line. And it's the most subtle version of the fourth seal that you could possibly imagine. It actually starts from a low before the low. That's where all these fourth and fifth seal lines originate, either a low before the low or a high before the high. And it's then met the fourth seal criteria going ahead, which it did quite soon after it started, which was in October 15, and by April 16, a bit longer maybe, say late June 16, it had met that criteria. So that line's been there. It's been on my chart for 2 and a bit years. And there have been times when I thought, well, it'll never get there. There have been times when it's actually got there and closed right on the line, which I thought would possibly end the move up, but it kept going, and eventually it just touched out almost exactly on that fourth seal line, and now it's in free fall. But my guess is that doesn't last much longer either. Let's have a look here. The stars, undoubtedly the stars of the year have been equities. You have to agree with that. And even though Nasdaq's been the number one performer, all of our analysis, or mine at least, basically comes from the S&P, which is a much broader index than the Nasdaq. And interestingly here, what I'm showing you is we had 2 huge bursts of volatility. One was in January, February, and the last one, of course, started in September, and it's still working its way out now. And between those 2 highs is a fraction, or a fractal, of 59, which is one of the primary Danielcode numbers. In fact, it's an half of 59, and we can't actually get the charts to work on an half, so effectively it's 30 instead of 29. 30, excuse me, 26, then 15, 26, 37, 44, 59, 62, 74, 89. This is 59 high to high. Very significant if you were watching that at all. This is on a 6-day chart. There are other interpretations you could have as well. This is a really, really telling picture of physics in action. This is also the S&P, and it's been running up. As you know, I show you this chart pretty regularly at webinars. It's been running up at Danielcode Trading Channel non-stop since since 2009, March 2009. In fact, this is a shorter and slightly more manageable piece of chart that runs the Danielcode Trading Channel from the lows in January 2016. And you can see it got up to 3 standard deviations from the mean. The darker blue line is the mean. We ended that. That stopped moving in January 2018. It's just been doing its thing since then. It went up and it made an important high, the first of the highs, the February high, right at 3 standard deviations from the mean. Pulled back, went along and made what is actually a lower high on the angular chart, but a higher high on the linear chart. But you can see where it went to. It went straight down to the bottom blue line, or at least the red dotted extension line from it, which is 3 standard deviations from the mean. This is Newton's physics. Any action has an equal and opposite reaction. So this market made its high for this move at 3 standard deviations from the mean, and you can see when it came down to 3 standard deviations from the mean, it had a huge big bar down, and then it took it a couple of weeks to stall there, broke through, went back, rallied, closed just above that line, and had another couple of bars that had their open or high or low or close right on that line. It was very strong support for a while, which of course has broken now. But that's real physics in action. When I tell you these markets are fractals and that they're all mathematically based, this is another way of looking at it. This is the angular chart. We've got an issue, and it's not with the headset, folks. There's a problem with this sound at the hosting company. We'll keep going through. Anything I notice missing a few words, I'll come back and repeat myself. Make sure you're getting it all. This look at this for some potential trading. I'm not suggesting we got all of that money, but you can see we've had 3 just massive runs. So, you know, you got some part of 17,000, 16,000, and 24,000, and it's those huge trend runs that really put the cream on your equity curve. If you didn't get a big part of those, because we were right on them, we had time cycles at the highs, the lows, everything. I've talked about them before, and I'm going to show you a bit more now. Extraordinary volatility, quite wonderful. And of course, to us, we get paid exactly the same whether the market's going up or going down. The only difference is the old saying is that markets tend to go up by the stairs and down by the escalator. And that's true. We get into decent downside moves, we get rewarded very quickly. All right, so let's move on from that. This is the February high in the S&P E-mini. I say repeat that, we lost there for a while. This is the February high in the S&P E-mini. And the blue line on the left of the chart is the start of this count. And we use for the time cycles, we use the Danielcode numbers of 44, 59, and 62. And then we use what we call the heathen number of 70. In fact, there's nothing heathen about it at all. It just comes from a different part of the book of Daniel. And 70 is the number that Sir Isaac Newton used. Sir Isaac Newton, the famous father of modern science. He actually wrote more about his Christian beliefs than he did about mathematics, incredibly though it seems. He used 70 as his time cycles from the book of Daniel, and he said the book of Daniel is the most important book in the Bible because it foretells the coming of the Messiah. And if you're interested in that sort of stuff and scriptural prophecy, etc., you can get that writing by Sir Isaac Newton. It's called Observations on the Prophecies of St. John. It's available on the web. It's free. So if you're into that sort of stuff, read it. I didn't read it until many years after I discovered the Danielcode, and I don't actually use the methodology that Sir Isaac Newton uses. But it's interesting that 70 is the last of the time cycles that we use. these time cycles work. This is a daily chart. They work on all charts. But it's particularly, 70 is particularly strong on anything with a European flavour to it. The euro, so you're trading that, the DAX, anything with a European flavour to it just loves this 70 time cycle. Okay, so have a look at what happened. This is the February high. Let me put my reworked microphone up there out of the way. This is the February high, and you can see that the high, which was January 29th, came exactly on that purpley looking line at 70, the time cycle. It starts from a low before the low. You can see the blue line on the left of the chart. That's a low before the low. It's actually 1 point higher than the next swing low. That makes it a higher low, or what we call the low before the low. And it starts from there, and there's the 70, gave us that February high, very late January high, 29th of January is the date of that bar. Absolutely spot on. And look what happened afterwards. I mean, this is when people start screaming about, oh, volatility. It's just totally not right, because markets continue always to run on these set ratios. So this is the same chart. It's just moved on a bit. We've moved our starting point for this account up to the high, the closing high, back in November 2017. Remember, there's a difference between the closing high and the chart high sometimes, and if there's a choice, they can only be within 1 bar of each other. Excuse me. If there's a choice, I always pick the closing high. What this has done now is it's put the 62 right on the low. This big plunge down, and the drama associated, 1, 2, 3, 4, 5, 6 days into the low, and that hit exactly at the 62 cycle. And then the 70 had moved on to give us the next cycle, minor cycle high. Just keep following. Initiation point, the starting point. We've now moved the initiation point. If you hear me repeating myself, folks, it's because I got a ding from the machine to say we might have lost sound for a second or two. We've now moved that start up to the high of that swing. That's actually the closing high of the next minor swing. Now look what's happened with that. It's put the 62 right on the late March, early April high. And we've got that before. We got that 2 or 3 different ways. Look what happens here. Keep moving it along. This is now September. This high came, and it was an unusual high, wasn't it? 62, we got the high, and then 1, 2, 3, 4, 5, 6, 7, 8, 9 days later, we got this counter trend rally high. And starting our count here from this particular low back in July 2018, the 62 gave us the high, the chart high, the closing high is the bar before, and the next cycle, the 70, gave us the counter trend high that really set this whole move off. So that's quite extraordinary, isn't it? You think this stuff's on to another low. I may say we moved the blue starting line, the blue line, on to another low. And look what we've got now. We've got all 4 time cycles hitting this chart. We've got 44 at the high that starts. This is the high after the high. That big rally started the big move down. That's where it really started. We've got the 59 giving us the big push down, which caused the small red counter trend bar. We've got the 62 at the low, and we've got the 70 at the chart high of the next rally. In other words, all of these markets have put in their highs and lows at known predetermined ratios. They're not the only known predetermined ratios. I don't want you to think there's a magic number on there that the market's going to hit. because it doesn't actually tell us which one it's going to be. And certainly none of these indicators go to quantum. These are about time, and therefore about time and price. But you can see how perfectly this, which seemed like some exciting splurge of volatility, it certainly was that. You can see how just specific this was. If we move high and the low where we're at now, I say this is the same piece of chart. This is where we're between the high and the low where we are now. And you can see by putting the blue starting line at the closing low, or that's actually the chart low, we've got the 44, which is the cycle from gold, giving us the second of those three peaks. Interestingly, those three peaks there, that's part of an old-fashioned pattern trading. If those of you who've been at this business long enough, before the days of computer and what have you, we had books that showed various patterns in market, and the three peaks, or the three little sisters, were notorious as precursors of a big down move, but they usually happened at the highs. This has happened below the highs. No one commented on that, so I guess either no one's old enough to have seen those books, or nobody cares. It's all about algos, or whatever you have now. So there you have the two, the second and third of those peaks before we had the sort of dynamic part of the rundown, one at the 44 cycle and one at the 62. In other words, the same thing again, that ratio between these time cycles. It doesn't change. It's inflexible. And no matter how much volatility and excitement is involved, all markets have to live by these rules, and they do. This is another extension of that. We've got the 44 on the last of the three counter trend highs there, and now you can see the 59's giving you the low, which is why I posted for you before I took a few days off. Get flat all your positions. There was one more day down in the S&P, and that was it. After that, we've had this struggling rally. Looking through last year's Christmas webinar, I said that trading time was the biggest deal in 2017. And you've seen this screen, excuse me, the screenshot. It's from last year's Danielcode. It might even be the year before, 2017. No, last year. This is it. I've made a couple of changes, nothing too much, but trading time has revolutionized trading as far as we're concerned here at the Danielcode, and I'm continuing to do the video tutorials in 2019, which have been absolutely sensational. But I've cut back the numbers. I did over 40 this year. It's too many. I'm going to cut back to no more than 30 students in the coming year. So if you're interested in doing a Danielcode tutorial, shoot me an email and I'll send you out some material you can read and get a feel for what's coming. But basically, if you attend these webinars, you can see how that trading works. So if the start of trading time was the biggest deal of 2017, the new success signals are certainly the biggest deal of 2018. We've been running them for you free of charge since mid-August. And we've had a heap of bugs that we've been working out as we went. Hopefully you didn't see many of them. Terry's managed to keep most of them hidden, but we've had to develop some background programs with that, which we've pretty well done now. We might need a couple more weeks before we release that on a subscription basis, but it's free at the moment, so as long as you're registered at the Danielcode, help yourself. The signals will be starting again next week after New Year's Day, and then it needs a holiday the day after. That'll be the 3rd of December. We'll start. Have a look at this, folks. This is the S&P E-mini, and these are the success signals, and you've all seen them. You've been with me all the way along here, and this doesn't take into account slippage, of course, and there's one signal that's not in here, which was the second counter trend. You can see the one after the second success buy. We had 49 ticks for about $612 profit. And then there was another buy the next day, which was about the same, a bit less, about $250 profit. It was a counter trend trade, but it made money. But between these trades here, and I haven't extended this down to the bottom bar because I'd actually closed out on the Friday. There's some part of $20,000 there per one contract. And this is a market with a very elevated margin of a bit over $6,000. But on any interpretation, that's something like 300-odd+% on margin in not too many days. So if you were following 6S, don't worry about the Christmas rally. You certainly got your Christmas presents early, didn't you? Because it's been quite fantastic. Yeah. Okay. Let's move on. 1, 2, 3. Well, it's come back now. It seems to just go off. It gives me a ding to tell me it has. This is crude oil. This was just a monster move. I'm not suggesting we got all of it, but boy, the 6S program was with this and on this all the way. It was one of the other really big performer, along with its associate heating oil. Of course, it's pretty much correlated with this one. But that was a huge player, and we're going to see a lot of volatility in crude oil next year, folks. It's one to keep your eyes on, as well as natural gas. Natural gas is interesting. I've been saying for a few years that the price of the futures contract Henry Hub natural gas is a fraction of what the international price is. And that's because historically the US hasn't had big export facilities for natural gas, but that's all changing now. And I do expect at some stage that the natural gas contract will start to reflect more of world parity prices. And if that happens, there's a ton of upside in natural gas. And one assumes that it's stuff about we're there and back. Here we are. This is more of our traditional stuff. On the S&P, you can see that the high came in at a fourth seal line, and we also had that same point on a fourth and fifth seal line, with a slightly different. And the run down went exactly to the first fourth seal line, coming off the little minor high before the January-February highs. So, same thing. Dormant, moving slowly, or absolute flash drama. Makes no difference. These markets have been running exactly to their Danielcode ratios all the time. And this is another form of a ratio. A fourth and fifth seals are angles, and an angle combines time and price. Every angle has a price at any point and also has time at any point. It's quite intriguing, that. Numbers. Where do we get the turn? Well, the low. We say Danielcode, S&P at the Danielcode numbers because they rudely dropped us off there. Let's have a look what we've got here. This was, find the chart, here it is. That low that came on December the 26th, that low was 231675. And we had a Danielcode blue line at 232250. 3/4 of a point, the only variance. They're absolutely extraordinary. And both the lines before that, both of the bars before that, had stopped almost directly at a Danielcode number. So markets continue to turn at the Danielcode and to observe all that's happening there. Okay, we're getting towards the end of this today, folks. If you are interested in being a super trader, shoot me an email, jneedham and what part of the world you live in, so that I can work out the time differential and make sure that I'm not calling you in the middle of the night. And I certainly won't use this headphone, otherwise I'd be calling you and you wouldn't hear me anyway. We'll try and find out what's been happening here before the next webinar, which will be in a fortnight. If you haven't already, folks, you're welcome to a free trial of everything at the Danielcode. Just go to the website, www.thedanielcode.com. Click on the free trial button. Terry will enable you for a 31-day free trial of everything that we do. And if you need a free trial of Trade Navigator, we can organize that for you as well. Okay, so let's see. Here's our compliance statement. Don't leave yet. Very important, compliance. If you don't know how to trade, you're going to lose your money really, really fast. I implore you, please learn how to trade before you risk any real money trading. It's trickier than it seems. From my family and Terry's family, this is the same Christmas card. We wish you all a very Merry Christmas, which we did already, and but we do particularly wish you a prosperous New Year. So that's us for today, folks. It's a bit of a shortened one. We're actually ending with about 6-7 minutes to spare, which is a change. Kevin, thank you. Mike, thank you. Happy New Year to everyone. Have a wonderful time. We'll be back at it starting on the 3rd of January. Danielcode charts have been updated all through this break. Will continue to be. Akshay, nice to have you here. And thank you for those good wishes, and the same to you and yours, my friend. And we'll look forward to tearing into it. This volatility is not going to go away, folks. Don't drop your guard. It's going to be wild and woolly, which is just how we love it. And that's not a pun about you, Hank, but thanks for being with us. Okay, folks, all the best. Glad to have you with us, and we'll look forward to you being with us next time. Bye for now.